that the attacks obliterated the sites. I think we can all safely say that there's not an element of anything that we can trust out of his mouth. Good afternoon, ladies and gentlemen, and welcome one and all to today's Markets Now session. It is June 23rd. Marks the first day of the last week of Q2. June actually finishes on Monday next week, but this is the last full trading week of the month. It's got off to a pretty good start over here at the desk. We had a nice win in the DAX this morning, which put us up well over 0.5% for the beginning of the week, which is quite nice. Definitely after a struggling week last week, which is pretty tough. Good afternoon, James. Good to see you, buddy. So, as we usually do, we're going to do a full market reports breakdown. We'll go through all the data and all the metrics, see what's occurring this week. Obviously, you are well aware of what happened over the weekend with President Trump pushing the button on firing on Iran, hitting several nuclear facilities. There's been a lot of power plays at the moment, I would say, from a political point of view. Iran saying nothing's been phased. They're unfazed by it. It's not really done much. Trump saying that the attacks have obliterated the sites. I think we can all safely say that there's not an element of anything that we can trust out of his mouth. But the fact still remains that the US has officially dropped bombs on Iran. Yes, James, quite so. And so therefore, this involvement is escalating day by day at the moment. And it's something that we absolutely must be taking seriously right now. If we are to be professionals, if we are to be here managing risk in the markets, it's crazy time, absolutely crazy time to be doing it. So yeah, hi there, Matthew. Good to see you as well, buddy. Good afternoon to you, Scotty, as well. Good to see you, mate. So first and foremost, I hope all of you had a really nice weekend. I, for one, did. It was a really, really nice weekend. Extremely hot. Did actually stick to my plan of going out mountain biking on Saturday. It was insane, actually, to be honest with you. I'm on a massive cut at the moment. If you don't know what that is, then it's basically just do the training. And usually go through a big bulk and then a big cut like every year. I'm on a massive cutting phase at the moment. Saturday was ridiculous in terms of calories burned. It was like 2,000 calories I got through on Saturday afternoon over the course of about 5 hours. So yeah, it was mental. Quite possibly, mate. So yeah, that was decent. I really enjoyed that. It's been really nice actually at the moment on the bikes, so that's good. And the whole family's been enjoying it as well. So we get to go and sort of partake in it together, which is decent. Yeah, so that's basically it on a personal note. Pretty decent weekend. Looking forward to this week. As I said, last week of the trading quarter. So hopefully we're going to be able to survive it without taking any significant losses. Ultimately, that's what it comes down to, especially these end of quarter weeks. You get a lot of commercial rebalancing as the big whales out there, the big funds, they're taking money from certain areas, they're placing it in others. You get a lot of profit being taken off the table as well, can cause quite a lot of volatility strikes, a lot of mixed volatility. But if you throw that in conjunction with the fact that we've got so much going on at the moment geopolitically anyway, it is chaos. It really is. It is chaos. I actually say this in the report right here. End of quarter volatility caused by commercial rebalancing and ever increasing tensions. Chaos. I didn't even look at that. When I was thinking it, that is exactly, what I'm thinking about this trading week. So it's gonna be, it's going to be tough. I don't think it's going to be an easy week. We can never tell ahead of time. We take day by day, but I do think it's going to be a little bit of a stretch this week to pull something out of the hat. So we're going to have to sit tight. We're going to have to buckle down and really get to work on it. I think it's going to take some serious effort this week to pull in some gains. So, with that all out of the way, let's dig into the market report. So last week, exposure was really interesting, actually. Forex had 56.25% exposure in our portfolio. Indices waning at 25%, with commodities closely following at 18.75%. Very interesting, actually, to see Forex at the forefront of that. And is it a coincidence that we only saw 1.89% realized growth? Not entirely sure if it's connected or not, but it is interesting to see that the exposure in FX last week actually led to a very struggling week. As you can see down here, it was a struggle. I mean, we took a 1% hit straight away. That's how the week started last week, followed up by a 2.46% day after that, followed up by a 0.5% day after that, then a loss of a 0.5%, then again a 0.5%. It was just all over the place. But the beginning of it really does show the sort of signs of mixed volatility in our markets at the moment, I think quite well. Going down here, we obviously added another 1.89% to our annual generated profits of 73.9% in total now, averaging out at 12.3% per month, averaging out at 2.9% per week. The weekly is ever dropping. And so I imagine by the end of the year, probably will be ended up at an average of around 1.3 to 1.5% per week. If you think every single week in a 50, well, it's not even 50, is it? It'd be like a 49 week or 48 week year. That's not bad, I don't think. I think that's pretty decent. Really, I don't know what previously has been done. Probably saw a lot. I would have said that the first couple of years of the portfolio probably were a lot more volatile in terms of the amount of gains that were generated. But at the same time, obviously, percentages rally very, very significantly when your account balance is a lot lower. So obviously, things are very much slowing down now. But the accounts are much larger. So yeah, you have to take that into consideration. In terms of longs versus shorts are catching up with long trading volume. I believe it was 7 trades last week, which are long, versus 9, which was short. So we were taking more shorts than longs. And and then we've got the UTCF return versus the S&P. So if you'd bought at the open of the S&P and just held to the top, you probably would have done a bit better. But that's fine. It is what it is. UK FTSE actually lost 1.81%. So moving down then into market trends and opportunities this week, we've got the Dow Jones, Euro, Yen, natural gas, and gold. Now, all four of these positions at the moment, again, I would like to reiterate that there is a significant level of inherent risk that we will be taking on board by trading anything this week. I was actually considering giving a blanket ban on 0.25% trading across our entire trading room, just because of the situation that we find ourselves in this week. It might just be best to trade 0.15%. I haven't actually officially made that statement yet, and so therefore, we are currently still at 0.25%. But I'm going to see how the week goes, because I think if it's going to be as difficult as I believe it will be, it might be worth scaling back on the risk per position. Now, looking at these, Dow Jones, first of all, let's zoom right in here. Wait, not that much. So US 30 Dow Jones so far then, still in that range, a lot of indecision at the moment. We've got ever increasing, obviously, tensions between the Middle East and US now, which is something in and of itself. We have to be very, very cautious here. I believe that the US 30 Dow Jones will just continue in the range, and there will be very choppy sort of market reactions over the course of this week. And so therefore, the US 30 Dow Jones, the most poignant place to think that it's going to go first of all is the previous high. So that's why that's been placed there. Looking at the weekly Forex expectation, Euro Yen. I chose this one in particular because of the Japanese yen and the euro, both of which are going to be pretty decent, I think, in trading off against, versus the US dollar, of course. And with the geopolitical situation underway at the moment, obviously the situation, is all explained down there. So if you guys haven't done so yet, please download the report, and then you can read my thoughts on that expectation. Moving down into the natural gas territory, natural gas at the moment is looking primed and ready to break out long, and I seriously am quite interested in natural gas at the moment. Not only do we have temperatures which are exceeding that of forecasts, and if you consider natural gas being a huge proponent of what do I always want in the office that I don't have? Air conditioning. Thank you very much. So yes, there is that, and also there is the fact that now with the US and what they've done, natural gas supplies run through the Hormuz Strait, and so if Iran starts blocking the strait and the supply of natural gas, is going to cause a demand vacuum. So it doesn't matter which one you look at it, even if you look at it from a cyclical perspective, a geopolitical perspective, it's all pointing demand. It's all pointing increase in demand in natural gas. So definitely watch that one. That's a space that I'm really watching quite closely at the moment. We come on to gold then. Now, gold's been in a bit of a funny situation at the moment because of the situation. You would believe gold is actually going to be on the rally, it's going to be on the steep rise, but it's not having that impact, and that is predominantly because of the style of the geopolitical situation that the US dollar finds itself in. Dollar will be in demand, and so therefore gold is not going to see that demand. Even though it's a safe haven to the US dollar, everything is purchased in dollar, so dollar has the purchasing power, and the demand is there because of war times. I'm using the term war, but please take that lightly. We're not exactly at the stage of all-out war, but the US is tampering with a far greater situation. I mean, look, I'm not pretending to be more clever than the officials in the White House. Okay, I would never say that, but they are tampering with the situation here and playing with fire, I believe, because of who Iran is extremely close with. So that there is a breakout geopolitically waiting to happen here. I'm sure there is, unless things get de-escalated fast. Yes, exactly, James. Yes, yeah, exactly. So gold at the moment's in a really interesting place, and I think it needs to be watched as well. Weekly expectation is for, of course, just a buyback to the previous highs, but don't think this is anything significant. This is just ultimately a continuation with the current channel that we've been trading in, and possibly coming up to test out the previous liquidity point of that chart before we get to see the sort of official next stage of gold price action. So moving down into market challenges, then of course I've got Middle East geopolitical situation in there. That's what that basically means, the situation with Iran, US and Israel. It's a neutral price bias across all bloody assets. It's tentative, and it is registering as a 10 out of 10 on the price expectancy scale, because anything could happen at any point in time, creating inherent risk throughout any trading activity. It doesn't matter what you're in, but there is inherent trading active risk throughout the entire week this week, at least, maybe moving forwards as well. Looking at Chair Powell testimonies, we've got obviously two of those, Tuesday, Wednesday, I believe. Neutral price bias across all US assets. We don't know what he's going to say. We don't know if he's going to have any views on the current geopolitical situation. Obviously, with a situation like that, it will ramp up inflation, and so there will be more dollars in supply with inflation. So therefore, there's going to be demand for dollar. So it's just a really, really difficult one to call at the moment in terms of like actual direction. I believe dollar will probably go long. That's my personal view, and I'll explain that when we get onto the charts in a moment. But for now, tentative, Chair Powell testimonies, neutral price bias across all US assets. And then finally, we have a negative price bias in the United States dollar on the Friday of the US core PCE, which will then again affect gold and euro and US 30 Dow Jones. Natural gas will remain relatively unaffected, but that one will affect those three, as well as the Chair Powell testimonies, which maybe have an impact across all three of those as well. So now we move down, state structure volatility. So Dow Jones has now been rebalanced. It was significantly higher than it is at 51.47% currently. And that comes down from, I believe, 55. So that's a big jump down there, and that's not a surprise, with what's happening at the moment. Euro yen at 49.88%, nothing to shout home about. The VIX volatility index is worth shouting about. Now it is at 50.19%, but this is a price increase, or not a price increase, a position increase from 44. So it's a big jump up. That's like a 6% rise in the VIX volatility index in terms of commercial longs versus their shorts at the moment. So probably expecting that increased level of volatility to bleed out into the markets. Natural gas at 56.12%, which is a clear notable call out there. A lot more longs in the market than there are shorts. And then gold at 49.68%, which remains relatively stable as well. But has reduced, I believe, from last week. So that's that. So moving now down into the economic and order book impact report. So with the econ and order book impact report this week, obviously we've got the USIR involvement. We've got the Chair Powell testimonies 1 and 2. The first one registering as a 5 out of 6. Please don't ask me why. I'm not entirely sure what it's picked up on there, but it is registering as a 5 instead of a 6. And then we've got the US Core PCE, which is also registering as a 5, and they are the majority of the big events this week. So it's actually quite a quiet week in terms of the economic data that's being released, but it is not a quiet week in terms of the broader view of what's going on with everything included. Now, moving down, it's a split 25% spread across all asset classes in our portfolio this week that we tend to focus on. Obviously, this doesn't include fixed income, but indices for FX, equities and commodities, 25% exposure to each. In terms of the total liquidity long and short, this kind of blew my mind, to be honest. Commodities at 56.17%. Now, don't quote, obviously, the whole entire market report list is inside the trading room, so you can go back and download any copy you want. I think they expire after a month, but you can go back and download the last copy 100%. It's still there. I believe the rise in commercial and non-commercial longs, which predominantly, I mean, this is all liquidity in the markets. Commercials obviously taking up like 99% of that liquidity, so it's ultimately it's commercial liquidity. But I think that's that. I want to say that is over 9%. There's been over a 9% jump from the previous commodity longs and shorts. So there is a lot of money buying into commodities at the moment. I mean, a hell of a lot. So oil, natural gas, and all the energy markets, but probably other commodities as well. So just be aware. Just be really aware. It's crazy times right now. Then breaking down into equities, we've got some really nice picks this week, by the way. Really, really nice picks. So please go and check them out if you're into your equity markets. Spotlight equity of the week is Datadog. AI-driven growth is driving this one forwards. I've also got a couple of bits and pieces down here. Institutional backing. It's got really strong analyst sentiment and fund inflows, making this a strategic mid-cap selection. So do check that one out as well if you are on the equity front. And that's about it, team. That is about it for the market report. So please, if you haven't done so already, feel free to go and download that one. Keep it to hand throughout the trading week. And we can start diving into the charts.